Welcome to this tutorial on how Webull margin works. Webull is a popular online brokerage platform that offers margin trading to its users. Margin trading allows you to borrow money from Webull to purchase securities, with the goal of amplifying your potential gains. However, it also increases your potential losses, so it is essential to understand how it works before using it. First, you need to apply for a margin account on Webull. To do this, you must meet certain requirements, such as having a minimum amount of equity in your account and being approved by Webull. Once your application is approved, you can start using margin to trade. The next step is to understand the different types of margin available on Webull. There are two main types: initial margin and maintenance margin. Initial margin is the amount of money you need to deposit into your account to open a position, while maintenance margin is the minimum amount of equity you need to maintain in your account to keep the position open. For example, if you want to buy 100 shares of stock with a price of $50 per share, and the initial margin requirement is 50%, you would need to deposit $2,500 into your account. If the stock price falls to $40 per share, the value of your position would be $4,000, and the maintenance margin requirement would be $2,000. If your account balance falls below this amount, you would receive a margin call from Webull. A margin call is a notification that your account balance has fallen below the minimum required amount. When you receive a margin call, you have a few options. You can deposit more money into your account to meet the maintenance margin requirement. You can close some or all of your positions to reduce your debt. Or you can do nothing and risk having your positions liquidated by Webull. It is essential to understand the risks associated with margin trading. If you use margin to trade and the market moves against you, you could lose more money than you have in your account. This is known as a margin blowout, and it can result in significant financial losses. To avoid this, it is crucial to use margin responsibly and to have a solid understanding of the markets and the risks involved. You should also have a risk management strategy in place, such as setting stop-loss orders and position sizing. In conclusion, Webull margin can be a powerful tool for traders who want to amplify their potential gains. However, it is essential to understand how it works and the risks involved. By following the steps outlined in this tutorial and using margin responsibly, you can minimize your risks and maximize your potential returns. Remember to always do your research, set clear goals, and have a solid risk management strategy in place before using margin to trade.